My first investment principle to help you build wealth and thrive is to buy assets when they are cheap. How do you know if they're cheap? Number one is cash flow, historic prices adjusted for inflation, and the cost of production. But let me be clear. I didn't always know this. In 2012, when I first started out, in fact, I had no clue what I was doing. And to better explain that, let me tell you a little story. I retired from the business world in 2012, and when I retired, I knew that I needed to start investing my own money, but I had no clue where to even start. So I was out on a quick vacation to Singapore, one of my favorite places, staying at the Marina Bay Sands. It was about 15 minutes before dinner. I remember it very well. And I was scrolling through YouTube, ironically enough, and I came across some videos by a guy by the name of Milton Friedman. Maybe you've heard of him. And every single video that I watched completely resonated, and I just went straight down that rabbit hole. And then I started to research guys like Jim Rogers, Marc Faber, Jim Grant, guys that were really coming from this Austrian school of economics mentality. And I knew that that's the type of investing that I needed to do. As soon as I got back home, I dove in head first and I researched as much as I possibly could. And I found a chart for U.S. housing. Keep in mind, this was 2012, and we had just gone through that big boom and that big bust. And I noticed that at that point in time, U.S. housing prices were at their historic trend line, adjusted for inflation, going all the way back to 1900. So the next thing I asked myself, okay, what's my downside? I pulled up a chart of the Japanese housing market in the late 80s, around 1990 or so, when they had their big bust, because I knew that it was a debt bubble that had popped just like what we had in 2008 and 2009. Their residential real estate market went down by about 60%, and at the time we were down by about 50%. So I assumed that my max downside was about 10%, and that's all I needed to know. I tried to figure out where I could get the best cash flow, and at the time that turned out to be Kansas City. So I went out there, and 2 or 3 months later, I owned 6 properties. And that's the story of how I first started to form that principle of make sure you buy an asset that is cheap. Using my personal story, let's revisit cash flow, historic prices, and cost of production. When I first went out to Kansas City, I was buying these rental properties for about $50,000. And I know that sounds crazy, but at the time the banks were just giving them away. And these were houses in really good neighborhoods, generally about 1,200 square feet, 3-bedroom, 2-bath. Buying them for $50,000, I'd put about $25,000 as a remodel, and I was renting them out for $1,000, $1,200 a month. My RV ratios were great, 1.3 to 1.5%, which translates to a net ROI of roughly 12% per year. That is cheap cash flow. Keep in mind, I've been able to raise rents every year since then. Historic prices. In 2012, when I was buying these rental properties, they're right in line with the historic trend line going back to 1900, adjusted for inflation. But this was the housing market in general. I was buying for a lot lower than that because I was buying these houses wholesale from the banks at the foreclosure auctions. Cost of production. I was buying these rental properties for under the cost of construction. So assuming demand stays the same, the only way for more supply to hit the market is if prices go up. So the biggest mistake that I see people make, and you don't have to look far for this, just turn on CNBC or Bloomberg, is they're always starting with the question, are prices going up or down? That is the wrong question. That is the opposite of where you want to start. You want to start by asking yourself the question, is the asset that I'm considering cheap or is it expensive? My second investment principle is make sure that you only buy assets that pay you to own them. In the last example, I told you a story of when I made some good decisions, bought some cheap property, formed that principle, and made some good money as a result. In this example, I'm going to tell you a story of when I actually lost a lot of money. In 2014, I was on the coast of Ecuador. It was this beautiful beach, and they had this one property left. And this place is where everyone wanted to live, just like Malibu in California. So I went to the seller and I said, listen, I'll give you almost any price for this, because my plan was to build condominiums. So I went ahead and bought the property, Unfortunately, I wasn't able to build the condominiums on the property, and I've had this piece of land just sitting in my portfolio, not making me any money for the past 4 years. I paid $150,000 for the property, which wasn't cheap, but I did that because I thought I was going to build, and I thought prices were going higher, which means I broke my very first principal. But to be fair, at the time, it wasn't exactly a principal yet. How much cash flow did I miss out on? If I would have purchased a house instead of that property, something that pays me to own it, I would have got about $1,500 a month times 12 months times 4 years would have been about $72,000 that I missed out on because I made that mistake. I did not buy with cash flow, I didn't buy what's cheap, and unfortunately it had low liquidity, so I'm stuck with it. The correct thing to do would be to buy what pays you to own it, buy what's cheap, and if you can, at all possible, make sure you're buying something that's liquid. My third investment principle is make sure you diversify. I'm not talking about between stocks and bonds. I'm talking about make sure you diversify your political risk and your currency risk. And to explain that further, here's another story. With this story, I want to go back even further than my time. And let's think about Germany. How did the politicians sell the general public on building the Berlin Wall? Do you think they actually went to the general public and said, hey, I've got this great idea. Let's go ahead and build this wall that's going to entrap you for decades to come so you can never get out? And you think the people said, oh, that's a great idea. Let's go ahead and do that. Of course not. The way this was sold is that it would increase their security. And brick by brick, as it was built, people walked right on by and thought that it was actually a good idea because it was going to keep the bad guys out. Well, we all know that it didn't keep the bad guys out, it kept the population from leaving. When a country gets massively in debt, like the United States, $22 trillion in debt, running trillion-dollar deficits, debt to GDP is close to 110%, they have to have your tax money. And if you leave and take that money with you, that money is no longer accessible by the government. So what can the United States do? Can they go ahead and build a wall around the entire country? Are they building a wall right now? Maybe that wall that they're building isn't necessarily to keep the bad guys out. Maybe it's to keep you in. Also, do they really need to build a wall? Maybe they can come up with something like FATCA that basically makes it so an American can't get a bank account outside of the United States. So if you want to leave, how would you take your money with you? What, would you just put it all in your pocket? They make it impossible for you to get that money out or to take it anywhere else. Effectively, they've already created a financial Berlin Wall around the United States, and it's only getting worse. Now we come out with Elizabeth Warren's wealth tax that suggests an exit tax of 40%. So if you want to leave, you've got to go ahead and prepay the government almost half of your wealth. And that exit tax may only apply to a very high dollar amount, but I can assure you, as the United States needs your money more, the level that that wealth, or that exit tax will kick in will get lower and lower and lower. That's an extreme example of political risk, but it's by no means rare. Go through history and you'll see that when governments get in trouble, they come after their own people. And one thing I forgot to mention, especially in the United States, is this drive towards a cashless society. So think about that. If the United States goes cashless, how will that apply to the wealth tax, capital controls, and your ability to leave if you'd like? Moving on to the currency risk, let's think about MMT, which is modern monetary theory. Their whole premise is you can print money without consequence, and you never have to worry about inflation, because if by chance inflation does pop up, what's the solution? To go ahead and raise taxes. And this is becoming very popular in the United States, and I guarantee you that this is going to be the political norm within 2 to 3 years in the United States. So if you have 100% of your assets in the United States dollar, and let's remember in 2014 the DXY was down at 70, it's at 97 today, but it can go very, very low. If you've got all your assets denominated in dollars, you've got to get some of that out of the country denominated in not only other assets, but gold as well. For more specific information on how to apply the investment principles I've talked about today in 2019 and 2020, and how to diversify your political and currency risk, go ahead and check out this content right here, and I will see you on the next video.